But I'd like first of all to thank Aidan and the faculty of the business school. We've got a wonderful partnership with them. As he correctly says, this is the third time we've been here, and he's referred to the fourth time when we come back again, and I'm sure there'll be many others. I, with some colleagues, started the Age of Scotland Institute last March, and we launched it in the Playfair Library of the University of Edinburgh, with basically a mission to reignite in tomorrow's leaders in Scotland the DNA that is in them all somewhere that carry their forebears to Asia, the Americas, and to Africa. It is quite extraordinary, actually, that a country that is half the size of Greater London in population has had such a huge impact in the world, mostly for good, mostly for good. So our mission, therefore, essentially at its core, is to re-engage Scotland with Asia and to equip tomorrow's leaders, many of whom are sitting in this room, rather than yesterday's or the day before yesterday's, with the knowledge and the skills to enable you to function effectively in Asia. And we've decided that the way to do that is to run programs with founder partners that we're drawing together now, looking at arts, culture and education, because to understand the extraordinary stoicism of the Japanese in the face of the earthquake and tsunami, you have to understand Japanese culture. And if you're thinking of selling products into China, you must understand Chinese culture. We will not be successful in all its diversity. We're looking at business and economics, and that is part of this. This is the Adam Smith series, that great thinker of the Age of Enlightenment, that genius cluster in Scotland in the late 18th century. The Adam Smith series, and there's going to be one a quarter, and as Aidan said, this is the third. We're immensely grateful to Stephen for coming here, who will be introduced shortly by one of our trustees at Neville, Washington. The other area we're looking at is policy and politics, and for that we will be bringing up a series of ambassadors from Asian countries to the UK to talk about their markets, to explain what's going on there, and also to engage with business journalists who will talk about what's happening in those same markets. So enough from me. I'll come back at the end to say a few words about what we're going to do, perhaps some practical ways in which, if you're interested, you can help us. But this is created for all of you here to get engaged with one of the most, if not the most important markets in the world. So thank you for coming. Neville Washington.
There are at least two authors named Stephen King of whom I'm aware. One of them writes horror stories. And in case there is any doubt about which one we have to talk to us today, then certainly for a horror story writer he has an unusual background. Started his career in the Treasury. They obviously must have thought something of him because he was for a time the private secretary to Terence Burns, who was then the chief economic advisor to the government. His career with HSBC has been equally impressive, and he's been their global head of economics for over a decade, and also the head of their asset allocation research. So very sensitive position. He regularly appears, he's a member of the Government Asia Task Force. He appears before the House of Lords Economic Affairs Committee. He writes a regular column in the Independent, Financial Times, and he appears on YouTube. And if you think that this now sounds a bit establishment, he also has a track record of making accurate predictions, which in the context of his latest book are going to be a bit concerning. He wrote a paper called Bubble Trouble, which accurately predicted the investment crash in 2000. So we are indeed lucky to have such a speaker to address us. Stephen.
Well, thank you very much indeed for those kind words. It is true that I'm an author. In fact, I started writing books because people come up to me and say, are you Stephen King, the author? I can now say, yes, I am, which solves that particular problem. It's very helpful for getting upgrades in hotels and getting decent tables in restaurants and such like at the last minute. So it's very handy having this name, even though I am in many ways an imposter relative to the other Stephen King. I wanted today to talk a bit about the book that's just come out, but actually mostly about this whole issue of the rise of Asia, the rise of China, and how it's changing the world economy. So the talks have been really two halves. The first half is going to focus on the Asian story and how this is really reshaping the rest of the world. And the second half is going to be more about the issues contained within the book, which in one sense are partly a consequence of the incredible performance of Asia in recent times. So I wanted to kick off with one of my favourite charts, which just goes to show how extraordinary the shift in Asia has been over the last few years. So this chart is a timeline. The line on this, the red line, is actually a history of per capita GDP, per capita national income in the US going back to 1700. What I've done on this timeline is simply to work out where China has been on this timeline over the last 30 or 40 years, just to get a sense of how swiftly China has changed, and in one sense how this has become a truly epic story in recent times. So in 1980, Chinese per capita incomes were the equivalent of those in the US in around about 1790, so just shortly after independence. And before, in fact, the Louisiana Purchase, which of course joined the US together in the way that it wasn't the case when the US was first formed. So this was really early stages of the US. China was that poor back in 1980. By 1990, per capita incomes in China had risen to levels in the US around about the time of the Civil War, a little bit after the Civil War perhaps. And then by 2000, we're up to levels that we'd seen in the US in around about 1890 or thereabouts. By 2010, so 3 years ago, per capita incomes in China were up to those in the US in around about 1940. In other words, China has delivered in each of the last 30 or 40 years, every 10 years, an improvement in living standards, which took the US 50 years to achieve back at the end of the 18th century and through the course of the 19th century. And that, to my mind, is an extraordinarily epic change in economic performance. And bear in mind, it's affecting so many people at the same time. China, of course, is an enormous population. We've seen these kinds of stories before in, say, Japan or South Korea, but never on this kind of scale. So this is a really remarkable part of the story. I also want to note that this is not China's story alone. It's also a story for India. India is perhaps not quite so impressive as China, but in India's case, the ratio effectively is that India achieves every 10 years what it took the US every 30 years to achieve. So this is a remarkable reshaping of the global economy that's occurred in a very, very short space of time. We've never really seen anything like it, which in one way is why it's so difficult to make predictions to what's going to happen in the future as a consequence of this truly epic change that's come through from China and from India. What this is doing first and foremost is to reshape patterns of world trade, and I wanted to focus on this by first of all thinking about how economies have done differently from decade to decade over the course of the last 50 years or so. Because I think the view maybe 10, 15 years ago was that if it were the case that China and India were so incredibly strong, it surely was a fantastic opportunity for the Western world and for Japan to grow very rapidly at the same time. The idea was that strong demand from Chinese consumers or Chinese companies, from Indian consumers and Indian companies would surely lift world trade, be very good news for countries elsewhere. And that actually has not been the case. So I've given here a sort of 50-year history of the world economy involving 5 different countries. This is the US, the UK, France, China, and India. And I start actually in the first decade, 64 to 73. There's no coincidence here, by the way, because these are the 5 decades of my life so far. This is a big year for me this year. I'm celebrating a particular birthday. I don't like to talk about it too much, but I obviously have done in the spirit of this audience. But what we have here is the first decade of my life, so to speak. We had very strong gains coming through from the US, the UK, and from France. China showed a particularly big increase in living standards, but a big percentage increase of nothing was still nothing. So effectively, by the end of this decade, China really wasn't much better off. India did nothing at all, so it was immensely poor at the beginning of this period and remained immensely poor at the end of the period. The second decade from 74 to 83. Not surprisingly, the Western numbers look quite a lot softer. This was the time of the two oil shocks. Of course, there was the Thatcher recession at the beginning of the 1980s. All these things happened, which were a huge constraint on growth. And not surprisingly, the Western world did rather poorly then. China was still growing pretty quickly, but again, it was a big percentage increase of not very much at all, and India wasn't doing particularly well either. Then we move to the 84 to 93 period, and suddenly that red bar for China looks quite a lot more impressive. Also, it's true that the Western world was beginning to pick up a little bit, so you might argue that China's strength was beginning to help Western economic growth. And then we have the period from 94 to 2003, which again showed pretty impressive numbers for China, increasingly impressive numbers for India, and the Western world again was doing actually reasonably, not quite as strong as was the case in the 60s, but nevertheless a return to some degree of strength from what had been the case over the previous 2 or 3 decades. The last decade, however, is really quite remarkable. This is the one that's really peculiar, because if you'd known at the beginning of this decade how the Western world was going to perform, you might have had a very different view about China and India. Or alternatively, if you'd known how China and India were going to perform, you might have had a very different view as to how the West was going to do. Because over the last decade, we have seen this remarkable decoupling, if I can call it that. There's a kind of dirty word, decoupling. People think, well, decoupling can't possibly happen. Surely these economies are all connected to each other. What happens in one part of the world always has an impact on other parts of the world. If the US sneezes, the rest of the world catches a cold, etc., etc. We know all those things. But over the last 10 years, something truly remarkable has happened. The growth of China and India has been truly spectacular, whereas the numbers for the Western world have been truly awful. Now, of course, part of that is a consequence of the global financial crisis, but also, I'd argue, it's because the rise of China and India has had rather unpredictable effects on other parts of the world. It's created examples of both winners and losers, and part of that is shown in these changing patterns of world trade. So, on the world trade front, I'll put my little projector thing down. I've forgotten where it is. Here it is. On the world trade front, this is a list of the top 10 exporters to China in billions of dollars in 2011, which was the latest data I had available at the time when I put the slide together. Now, Hong Kong is number one. Doesn't really count, because of course this is all to do with common production platforms in Hong Kong and the mainland, so there's stuff that's just going across the borders all the time, which is not necessarily being consumed by anyone either in China or in Hong Kong, so in one sense it's a bit of a peculiarity. But what you see in this top 10 are a number of features. The first is that the countries which are geographically close to China have done pretty well, most obviously Japan, and particularly South Korea. 10 years ago, South Korea's exports to China were about 3% of South Korean GDP. They're now about 12%. There's been an amazing transformation over a relatively short space of time. You've got the US, which is in 4th position. In one sense, that's rather surprising. The US is so low, given the fact that the US is the biggest economy in the world. It's in 4th position. Then we have Australia in 5th position, major commodity producer, of course. Germany in 6th position. And then you've got a whole bunch of other countries which are also major commodity producers. So in one sense, what this table is telling you is that if you happen to be a commodity producer, you've done pretty well from the China story over the last few years, largely because China has per capita incomes which are still pretty low. And we know from the experience of South Korea and others that so long as per capita incomes are low, growth tends to be disproportionately focused on commodities and commodity demand rather than other kinds of things. And also, again, you've got that example of countries which are geographically close to China. Now, what you also notice, of course, there's only one European country in the top 10, which is Germany, which happens to be very successful at making capital goods. And of course, China also has this extraordinary demand for capital goods in recent years. In fact, China has been the biggest single player in the capital goods area over the last 10 years, completely dominating countries like the US. So if you want to do well with selling capital goods, it very much is a story to China rather than to, for example, the US or elsewhere. Now, as for other European countries, well, I go on to my next list, the top 20. On the top 20, you've got, well, finally you find France in position number 17, really quite a long way down. And actually, I was in Paris recently, and I pointed out to some of the people in the audience that France was only in 17th position. And they clearly looked very disappointed, in fact, rather upset, perhaps, that I had pointed out this severe French weakness as a kind of insult to their Gallic pride. And I looked a bit down the dumps and so they pointed out that, well, actually, there's still a country missing from this list. I then got to position number 22, finally found the UK. at which point the French cheered up enormously. They felt that actually there was a relative success, and that was all very encouraging. Actually, there was a bit of cheating going on here, and it is important to point this out to make us feel better about our relative underperformance compared with the French. And that is that Britain makes the wings and the engines for Airbuses, which are then exported to France. France then assembles the Airbuses and then exports them to China. So it makes it look as though France is doing really well in exporting to China, and Britain isn't doing quite so well. But that in one sense reveals some of the difficulties in analysing these statistics. But nevertheless, this story is one that has been not such good news for any European country, with the possible exception of Germany, in recent years. In one sense, it's because the per capita incomes in China are still rather too low to allow the kinds of products made in Europe to actually expand rapidly to China in the years to come. So that might change, of course, but at the moment I would argue that the biggest winners from a trade point of view are those effectively who are commodity producers, those who are geographically close to China, and Europe as a whole, apart from the honourable exception of Germany, has generally done rather poorly. France and Britain probably roughly about level, even though I didn't point that out to the French when I was over in Paris at the time. Anyway, I also want to argue that we're going to see even bigger changes in patterns of world trade in the years ahead. Now, this map comes from the World Bank. It's a slightly odd map in some ways, because you can see that the borders are thicker around some countries and regions than around others. And what the World Bank tried to do was to measure, if you like, the economic borders between countries, rather than simply the political borders. In other words, how easy was it to conduct trade between different countries around the world? And what you'll see immediately here is that for the developed world, for North America, for Western Europe, for Japan and so on, the economic borders are remarkably thin. It's very easy for these countries to trade with each other. Now, of course, if you drew a similar map back in 1945, you would find that the borders around the OECD countries were again very, very thick. This is before we had institutions like GATT or the European Union or WTO, which have helped to reduce these borders over time. In fact, over the last 50 or 60 years, we've seen two real revolutions in world trade. The first was the opening up of trade in the 50s and 60s between the so-called OECD countries. And the second was really a kind of east-west opening up of trade associated with the collapse of the Berlin Wall, the reforms from Deng Xiaoping opening up China to the rest of the world. So you had huge amounts of trade growing between the US and China, or between, say, Germany and Russia. But today I'd like to argue that there's another revolution coming through which effectively bypasses the Western Europeans, it bypasses North America, it bypasses Japan. It effectively is a South-South revolution. And what I think we're going to see in the years ahead is effectively the shrinkage of these economic borders around all these countries that exist in Asia or in sub-Saharan Africa or in Latin America. And that's where, if you like, the big opportunities for world trade will be in the years ahead. And this really argues that effectively there's still great opportunities for growth in the world. It may simply be the case that the opportunities aren't in the States or Europe, they're in other places whereby things can really change in a fairly radical way. And so what are the nature of these borders? Well, here's a list that the World Bank has put together. There are tariffs, capital controls, limits on migration. There are landlocked countries. There's an issue about country size, ethnic, cultural, religious divisions, conflict, disease, a whole bunch of things that all prove to be very, very difficult. But I think the incentives for this to change in the future are growing very, very powerfully. Part of the reason for this is, of course, the demand that China and India have for the world's commodities, which are obviously to be found increasingly in places like Latin America and like sub-Saharan Africa. And also because I think as trade opens between those regions, some of the products made in China or made in India, particularly things like cars, will increasingly be exported to other parts of the emerging world. So there'll be new connections being formed, new incentives to form those connections, which I think will help to reduce those borders in the years ahead. Now, just to give examples of this, and people talk about China as effectively a country with high quality of capital inflows from Western or Japanese companies alongside cheap labor. And the idea is somehow you put those two things together into the mixer and China does incredibly well. That's not quite true. It's certainly true that China has been helped by that particular mix, but China also has made huge investments in infrastructure, particularly in the eastern provinces over the last few years. And this table it's not normally my area of expertise, the volume of container shipping ports in different parts of the world, but this is quite a useful way of illustrating this issue about the quality of infrastructure. So back in 1989, if you looked at the top 10 container shipping ports by volume, you'll see from this little table that not a single one was in mainland China. And by 2009, you'll see that of the world's biggest container shipping ports, 5 out of the top 10 were in mainland China. And this is important from a Chinese point of view, but it's also important from the perspective of other countries in this kind of south-south trading zone, because many of them still have very poor infrastructure. In fact, looking at the container shipping ports by volume in the emerging world outside of Asia, and looking at the world's top 50, of that top 50, only 4 are in the emerging world outside of Asia. One's in Brazil, just next to Sao Paulo, and the other 3 really are cheating. They're not really emerging market ports, even though they're in the emerging markets, because 2 of them are at either end of the Panama Canal, and 1 of them is at one end of the Suez Canal, so they don't really count in the sense of doing lots of trade with Panama or with Egypt. My point about this, though, is that in the years ahead, I think China, with its really relatively deep pockets, will be investing not just in infrastructure in China itself, but increasingly investing in infrastructure in parts of the world that China needs to do trade with, which means investments in Latin America, it means investments in sub-Saharan Africa. It raises all sorts of questions about neo-colonialism and so on, but nevertheless, I think this is going to be a big driver of connections between these different parts of the southern economy, and that's, I think, an important driver for the future. Similarly, same story with airports. If you look at the top countries for commercial flights, back in 1980, where you struggle to find many emerging markets there, Brazil's in position number 7, Mexico is in position number 10, but otherwise nothing much going on there. But look at the latest figures for 2008, China in 2nd position. Complete transformation in China itself, new connections within China, and of course increasing connections between China and other parts of the world. Again, we'll see more of these connections growing, I think, in the years ahead. Those connections are very, very important. And going back to this idea of what sort of trade can be done, I mentioned commodities, I also mentioned cars. And this is a little table which looks at cars per 1,000 of households, or per household. And what the chart looks at is a log scale left-hand side, and basically shows that in India, the number of passenger cars per 1,000 people is roughly 10. In China, it's maybe sort of 30 or 40. Russia's about 50. Brazil's quite a lot higher. But these little blobs to the right-hand side are what you typically find in the Western developed world. These are all observations of Western nations. So effectively, car ownership across the emerging world, particularly in parts of the BRICS, is still remarkably low. That will grow very quickly as per capita incomes rise in the years ahead. And already in China and India, you're seeing developments of internal car industries designed primarily to service their domestic customers, often created behind closed doors, using the infant industry argument, which of course was used by Japan and South Korea and others back in the 60s and 70s, but also importantly used by the Americans back in the 19th century. So people might say it's protectionist, but at the same time it does allow these countries to gain economies of scale, which then means they can sell their goods not just within their own countries, but increasingly to other parts of the world. And here's a fundamental difference in my view, which is that the quality of cars being made in China and India is a little different from the quality of cars being made in the US or Europe. I don't mean to insult the cars being made in China and India, but they are different. They're different for a number of different reasons. Here's one example of an Indian car, the Tata Nano, which actually is not sold very well, partly because people like to buy a car which has a powerful sort of sexy image, and I'm afraid this one doesn't quite count. In fact, it's just a little bit too simple, a bit too basic, but it's probably the cheapest car being made in the world. It was designed in one sense to try to appeal to the Indian first-time car buyer who was previously transporting their family around on a moped in downtown Mumbai, and actually moves for something a little bit better. Now, the point about this little story is that a lot of the cars being made in India and China are smaller and much lighter and much cheaper than is the case in the Western world. And one reason for that is that in the West, we've added hugely to the size of cars through safety features, which are not necessarily quite as important in China and India, but also because Westerners themselves have changed in terms of their tastes. And actually, this is one way of showing this. This is the average car weight in the US over the last few decades. And you can see something striking, of course, in the middle of this, where the average car weight collapsed in the 70s, from those big sort of gas guzzlers that we saw in American Graffiti and other such movies, to something which was slightly more sensible given the increases in oil prices in 73 and in 79. you can also see is a kind of creep back upwards over the course of the last 20 or 30 years. In fact, that creep is rather similar to my occasional weight loss programs that, I lose a lot of weight and look sort of pretty good for a little while, and then it all just gradually comes back on again. And actually, cars have gone through the same kind of process. And in fact, there are two reasons for this. The first one is that car weight has gone up because safety features have actually gone up quite a long way. So all those airbags and bars to protect you from cars driving into the sides have all added to the weight of cars. But the other reason is that Americans have got bigger. They haven't got taller, they've just got bigger. I'll leave you to think about the implications of that. But effectively, the average weight of an American man back in the early 60s was about 73, 74 kilos. It's now about 95 kilos or something like that. So it's gone up quite a long way. Of course, there are plenty of American men who are remarkably fit. But of course, that simply implies there are plenty of other American men who are a little more skewed in the opposite direction. But the point about this, you've got a family of 4 or 5 people, and you're quite a lot bigger in total. So 5 people, an extra sort of 60, 70 kilos to carry around. You need a bigger car, you need an SUV or a truck or something like that. Effectively, that's one reason why the cars have got bigger. Now, the reason why I mention all this is because a Tata Nano is absolutely useless for an American family. When you look around the emerging markets, you'll find, of course, that people, there are exceptions again, of course, but in general terms, you'll find that people in the emerging markets are a little more svelte, a little slimmer, and therefore they can get away with much smaller cars. And I use another example actually here. I talk about these American gas guzzlers, but I drive a Mini, and fortunately I drive a new Mini rather than an old Mini, because the new Mini is about 1.5 times the size of the old Mini. It's a lot bigger, in fact, and this is just a general trend we've seen in cars across the Western world. Now, the point about this story is that when it comes to trade in cars made in China, made in India, I think an increasing number of those cars will not ever be sold to people in Europe or to people in the States. They'll be sold increasingly to people in Latin America or in sub-Saharan Africa or the Middle East, whereby there is strong demand for very basic cars, simple, cheap, cost-effective, without those safety features, but importantly designed for people who have not eaten quite as much as Americans or Europeans. So that's one reason why I think we're going to see changing trade patterns. So what does all this imply? Well, this is a little snapshot, actually from 1950 to 1960, of the way in which trade opened up across the OECD. So I've got some examples here, effectively the G5 countries, just looking at the bilateral trade growth. And the numbers back then were absolutely remarkable. Really amazing increases in exports over that period. So if you look at exports from Japan to the US in the 1950s, they were averaging 20% a year. So think about the cumulative effect over many, many years, an extraordinary opening up of trade. And what I'd like to argue is that these kinds of compound growth rates we saw in the 50s and 60s in the OECD are the kinds of compound growth rates you might begin to see across the emerging world. So when people say, well, how can China carry on growing in the absence of American demand or European demand, the answer is they'll sell increasingly to other parts of the emerging world. And how will the rest of the emerging world carry on growing? They'll sell increasingly to each other and to China. So this is a big revolution. And just to give an illustration of what this all means, this is a little chart which shows our calculations of likely export growth over the next 30 or 40 years for China through to other parts of the world. And the thickness of the arrows captures, if you like, the relative shift in export growth. And of course, what you'll see here is that there's tremendous growth going through to the Middle East, to Africa, to the rest of Asia, partly to Russia, and into Latin America. But you can also see that there's actually very little growth coming through to the States or to Europe or indeed to Japan. So there's still growth. It's not as though things go into reverse, but the relative change that we're likely to see in the years ahead will be dominated by these south-south linkages. And Brazil, exactly the same story, but in reverse. Now, Brazil already trades hugely with China, but I think opportunities for further trade will be growing very quickly in the years ahead. Now, of course, things can go wrong. It's important to stress that this is not guaranteed to be one-way traffic. There are a whole bunch of geopolitical questions about China's role in the world economy and world politics. There are issues about China's increasing influence in Latin America and how the US will be able to cope with that. There are issues about changing trade patterns in Asia, partly through effectively politicized trade agreements, like, for example, the Trans-Pacific Partnership, which certainly includes Japan and many other countries in Southeast Asia, but funny enough doesn't include China, which in one sense is a way of America trying to preserve its influence in parts of Asia. There's lots of things that can go wrong, but nevertheless, I think this is the way forward for the world economy, and it's one that's driven increasingly by what's happening in the emerging world, rather than what's been happening in the developed world. And this brings me neatly back to some issues with regard to the developed world. Now, what I want to do here is go back to that original idea of the fact that despite the strength of China and India over the last 10 years, we haven't really seen equivalent strength coming through in the States or Europe. And this little chart looks at the difference between the profit share in US GDP and the investment share in US GDP. And it's quite striking because the profit share is very, very high currently. One reason why equity markets have rebounded, of course, there's a whole bunch of QE stuff going on as well. But nevertheless, equity markets are partly strong because profits in GDP have held up remarkably well in recent years. But the investment share in GDP in the US is actually rather low. And of course, one reason for this is that US companies these days may have lots of profits, but there's no particular reason why they have to invest in the US. They could choose to invest anywhere else in the world. And of course, part of the investment we've seen in China over recent decades is not so much Chinese companies investing in China, it's American or European or Japanese companies investing in China, going back to the improvements in infrastructure, the low labor costs and so on. So we've seen plenty of investment globally, but actually not much of it has happened in the US and Europe. And where it has happened, often it's been the wrong kind of investment, things like housing, rather than necessarily investment in plant and equipment. And so here I wanted to demonstrates some themes that affect the Western world as a consequence of the rise of China. And the way to think about this is to consider a very simple two-country world where there is only the US and China and nobody else. So this is one of my neat ways of trying to think about issues by making them incredibly simple, which helps me because I'm a person with a very small brain, so it helps to sort of simplify these kinds of things. So here's my little chart, here's a map of the world with China in the middle of it. So assume the rest of it doesn't exist, it's just China. And I thought, well, with a very simple observation, which is that China saves more than it invests. In other words, it runs a current account surplus. And that's been broadly true over the course of the last 20 years. In fact, the current account surplus, to be fair, has been falling rapidly over the last 4 or 5 years. But before the global financial crisis, it was up to about 10% of Chinese GDP. It was a very, very large number indeed. Now, my two-country model, if China saves more than it invests, it has to acquire assets elsewhere in the world. And of course, those assets that have been acquired are in the US. Now wait for this. This is the most exciting part of the presentation, I believe, because look at that. Now, I'm really pleased with this. I mean, it may be that the content's not very good, but the delivery, I think, from the point of view of the slide is just wonderful. It took ages to work out how to do this. But anyway, we've spun the world around, and what we have here is China purchasing US treasuries. And of course, this is partly because the Chinese want to keep their money nice and liquid, possibly for all sorts of odd reasons, but nevertheless, they keep their money liquid by buying treasuries. It's effectively the equivalent of the Chinese putting their excess savings in some kind of banking system. Imagine US treasuries as the equivalent of bank deposits internationally for Chinese savers. So this is what happens. Now, that purchase of treasuries means that US companies end up with lower costs of borrowing than would otherwise be the case. They invest a lot in housing in the US, of course, but they also invest increasingly in factories in China. So effectively, what's happening here is the Chinese deposit their money in the US financial system. That allows borrowing to take place in the US, which is then reinvested back in China. So Chinese investment picks up as a consequence of this. So it's effectively financial flows into the US and physical investment flows back into China. Chinese investment booms, which we've seen over the course of the last few years. Chinese workers end up with higher wages, not because they're becoming less competitive, but rather because they're becoming more productive. This is the whole process of urbanization. Higher wages are a reward for being more productive, rather than because necessarily having terrible inflationary problems. So higher wages come through, and at the same time, because China is more productive, it is now exporting more to the US. You see that spinning around again. I'm going to reverse that so I can do it again. It's so exciting. So there you go. It exports to the US at this point. And US consumers end up with cheaper goods. So it looks like everyone's winning from this particular story. There is, however, a catch in this story, which is that although US consumers end up with cheaper goods, US workers end up with lower wages. And because of the subsidy to the cost of capital in the US, lower treasury yields, US households end up with higher levels of debt. At the same time, US companies end up with higher profits because, of course, US wages are now lower than was the case previously, and those profits are then reinvested back in China. So the point about this is that what China has done in terms of its rise has been to change relative prices of a whole bunch of things, which in one sense make it difficult to analyse from the Western world's point of view whether this is entirely a positive story. Certainly the trade story, the idea that the West can export to China, is itself positive, but there are a whole bunch of other things that have changed that I don't think were spotted 10, 15 years ago. So effectively, downward pressure on Western wages. No doubt that if capital is more mobile, and it goes increasingly to Asia, it is more difficult for Western workers to negotiate significant increases in pay. That's undeniably true. It's also the case that before the global financial crisis, the way in which society dealt with this absence of any increase in pay, this increase in income inequality over the last few decades, was dealt with by effectively access to cheap finance, which allowed household debt to rise very quickly. So one of the peculiarities before the financial crisis was that household debt levels rose rapidly. Consumers were able to keep spending even though their income wasn't rising particularly rapidly. And what you ended up with was a big increase in income inequality, but not necessarily a big increase in consumption inequality because people had access to debt or to credit. Of course, since the global financial crisis, that's all changed. People are now much more aware of the fact that their incomes have been depressed because they can't get access to the credit. As a consequence, the people are beginning to recognize, they think, that globalization has not been entirely a free lunch for everybody. And I would argue that that's one of the reasons why we're seeing a return of some degree of economic nationalism, because we've got the stagnation, we haven't got the credit growth, we've got the income inequality. All these things don't look quite so nice now as had been the case before the onset of the global financial crisis. This brings me back to my earlier chart. I mentioned before that we'd seen this incredible slowdown in the Western world. I've described some of the reasons behind that from the perspective of the impact of China and perhaps some of the misallocations of capital, the investment in housing and so on. I want to go a bit further now. I wanted to suggest that there are some other factors out there. And whereas China and the southern economies, I think, are going through a revolution, I think the West probably in one sense has already been through a significant revolution over the last 60 or 70 years. And some of those benefits were one-offs that we assumed were going to be continuously coming through. But because they're one-offs, actually, we're discovering that underlying growth is beginning to slow down. I think it's been slowing down for quite some time, and we didn't really want to admit to this. But what are the drivers? What are the key drivers that were so important over the last 40 or 50 years that maybe are fading from view currently? Well, the first one is the opening up of trade. In the interwar period, trade was really repressed. There was no real connection between countries. It made it even worse, of course, during the Second World War. But from the 50s onwards, trade has opened up enormously. You saw those spectacular increases in bilateral trade growth in the 50s and 60s. But you can only really have that once. You can only open up your trade once. You can close it down again, of course, but you can only open it once. So those kinds of trade increases that we saw, those multipliers we saw in the 50s and 60s, I think are unlikely to come back again. So some of the benefits we have seen from the opening up of trade from a West's point of view are one-offs that will probably point to lower growth in the future. A second factor, education. If you look at the number of college graduates emerging from the US in the 50s, it was still remarkably low. It's now amazingly high. Particularly female graduates have gone up dramatically since that period of time. So in fact, the quality of the human capital stock, so to speak, has risen enormously. So again, there may be limits as to how far you can go in terms of continuously raising the capital stock. You can have increasing numbers of people in education for a certain number of years. But you can't keep increasing the education year after year after year. There are limits as to how far you can go in that particular area. There's the emancipation of women in the workforce. Very few opportunities for women in the Western world in the 1950s. A huge transformation over the last 30 or 40 years. It's not perfect. There are still far too many glass ceilings out there, but nevertheless, there's been a significant change relative to where we were 50 or 60 years ago. So again, a big one-off increase in productivity and capabilities over that period of time. Another big change, consumer credit. We think now about consumer credit being a bad thing rather than a good thing, but consumer credit as a share of GDP, or household debt as a share of GDP in the US was about 40% back in the 1950s. Before the financial crisis, up to about 140%. I think it's very unlikely we're going to see further increases in the years ahead. And that's a problem because, of course, without further growth in debt, you can't get the economies of scale of further increases in mass production. And it's worth noting that consumer credit first took off in the 1920s at the time of mass car production. So if that reaches a limit, it probably limits the amount of demand that will come through for a whole series of goods and services. So for all these reasons, I think that the Western world has bumped into constraints which have been difficult to deal with. And in fact, I would argue that the policies adopted at the beginning of the millennium were designed to try to keep growth going in the light of these constraints and actually made the situation worse rather than better. So if I take the example of the US, at the beginning of the millennium, there was a dot-com bubble that burst. There was a tremendous worry in the US about having a Japan-style stagnation. So the US offered dramatic policy loosening. There were amazing interest rate cuts. There was a huge fiscal stimulus through the Bush tax cuts, the equivalent to about 6% of GDP in the space of 4 or 5 years, and really a huge fiscal stimulus. And yet despite all that stimulus, and despite a housing boom, and despite massive increases in leverage, the underlying growth rate of the US was already slowing, an average of 2.5% between 2000 and 2007. This is a peak-to-peak comparison, so adjusts for the economic cycle, relative to averages of 3% or so in the 1980s and 1990s. So if you take away the housing boom, take away the fiscal stimulus, take away the monetary stimulus, take away the leverage, what are you left with in terms of future growth? Probably something quite a lot lower. But we don't want to accept this. We want to believe that a recovery is just around the corner, and this is built into the thinking of our political institutions. And this is one example of this. This is actually forecast from the UK, and it's from the Independent Office for Budget Responsibility, which of course is not affected at all by what the Treasury might think, even though the OBR is staffed primarily by ex-Treasury officials. But the point about this, this forecaster is that it tries to produce these independent views. There's something very odd about the forecasts. These forecasts show the level of GDP in the UK, not the growth rate, but the level of GDP. And they've indexed these to equal around about 100 or so in 2009, 2010. So effectively, in the depths of the economic and financial crisis. And what I've tried to show is how the forecasts have been made. First of all, back in 2010, June 2010 was the first forecast the OBR made, and then in March 2012, and then March 2013. And what you'll see is that actually the forecasts are identical in one specific way, which is that the recovery is always next year. It's just that next year never really arrives. But the reason why we always think the recovery is always next year is because particularly we don't want to face up to the consequences if actually growth is significantly lower on a structural basis than we had previously assumed. This is actually really scary stuff, because if growth is significantly lower, you end up with a really big deterioration in fiscal positions and debt positions in general. Remember that the crisis was about debt in the first place. The way to deal with debt is to have lots of income growth to pay off your debts, but if there isn't any income growth, the debts just get worse and worse. So despite all the austerity that Britain's been through in recent years, and I should point out that much of the austerity that was planned hasn't even happened yet, but despite the austerity that's happened, this shows the impact on the UK economy of those persistently disappointing growth rates year after year after year. This is looking at the ratio of government debt to GDP. Again, these are forecasts from the Office of Budget Responsibility, and again you'll note a similar kind of pattern, which is that always in about 2 years' time, the ratio of debt to GDP will peak and then come down. It's the same forecast every time. It's always in 2 years' time this will happen. So effectively we've got a situation where we're gearing ourselves into an expectation of stronger future growth, and so far that growth hasn't really materialized. So my question is, what happens if the distortions from Asia and all those longer-term drivers of growth are beginning to fade? What happens if we're now faced with actually lower trend structural growth rates than we thought was possible before the financial crisis? How do we live within our means in these new straightened times, these more difficult times? And this is really the theme of the book that is now out. The answer so far is to pretend it's not a problem. This is what I like to call the theological option. In economic policy making, you constantly pray for a strong recovery, and lots of politicians have been very much in favour of that, but unfortunately, as yet, the prayers have not been answered. This is not a theological discussion about the existence of God or otherwise. I'm just simply saying that the prayers have yet to be answered. But you pray for a strong recovery, and one way of trying to do that is through magical monetary policies, quantitative easing, and all these other bits and pieces that have come through in recent times. Now, when QE policies were first adopted, I would argue that they were regarded as the equivalent of a powerful course of antibiotics. That the patient was ill, you applied these QE pills to that patient, and there'll be a strong recovery in economic activity. You look at the forecast made by the Federal Reserve or the Bank of England or the Congressional Budget Office or maybe the OBR, over the last 4 or 5 years, they've all been consistent with the idea that monetary policy through QE fixes any known problem. What I'd like to argue, actually, is that although the aim of QE was absolutely admirable, and in one particular way it worked incredibly well, because I think we were genuinely threatened with a Great Depression back in 2009, we've avoided that outcome, which is fantastic news. I think it's also the case that QE has morphed from being this rather attractive antibiotic into becoming simply an addictive painkiller. It's a different kind of story. It makes life a little easier, but doesn't really solve the underlying economic difficulties, in particular the absence of decent, strong economic growth. And one way to demonstrate this is to think about what we might describe as the distributional effects of QE that were not properly understood when it was first adopted. The line from the Bank of England at the time was to say, QE will definitely create benefits through portfolio channel effects, but it won't have any costs whatsoever. Now, I think we've discovered that subsequently there have been some costs, and what I'd like to point out is this. QE came after the big fall in the sterling exchange rate, but I'd argue that the big fall in the exchange rate was partly in anticipation of QE happening. When the exchange rate was falling, everyone knew the Bank of England was going to have to do something really quite extraordinary. It was just a debate about exactly what sort of extraordinary measures they would adopt, what kind of unconventional stories they would begin to push towards. So you had this big fall in sterling, and the original idea was that this would help to rebalance the UK economy. There's this great idea that we'd have weaker consumption, weaker domestic investment perhaps, but roaring exports. And this is based on actually the experience of the 1930s when Britain came off the gold standard, when indeed there were roaring exports and the UK was able to grow quite nicely, even with the depression still in place in countries like the US, France and elsewhere. So there was if like a historical precedent for the idea that a big fall in the exchange rate would create huge benefits. This reminds me of a conversation I had in Beijing a year or so ago when I was describing this precise idea of rebalancing. I said to my business person in Beijing in the meeting I had, I said, well, of course, the strategy of the UK government is to have this big fall in the exchange rate, to rebalance, to have export-led growth. And she said to me, but that's all very interesting, but the UK doesn't export anything, which was a somewhat rather disturbing sort of view, which does suggest we should be out there being much more vocal about the things we can export, because clearly there's an image problem elsewhere in the world. But more importantly, I think that exports didn't pick up, partly because we have certain engagements with the Eurozone which have rather limited our success on the export front. But also I think that the fall in the exchange rate actually led to a significant squeeze in domestic real wages. Import prices went up, headline inflation rose, but there was no increase in wages. In fact, we've had some numbers this morning, latest labour market data in the UK, which show minuscule increases in wages against a background of still relatively elevated inflation. And what this basically means is that over the last few years, consistent with the fall in the exchange rate, is that we've seen real wage growth in the UK continuously shrinking. It's been really quite an extraordinary story. The worst period for wage austerity, if you like, since the 1920s. This is not exactly a happy story. Now, of course, you might say, well, the alternative was even worse, which is probably true, because the alternative would mean a much bigger increase in unemployment. So in that sense, it's good news. But at the same time, this continuous squeeze in real wages is definitely not helping any signs of recovery. At the same time, there are some people who have done really, really well out of QE, particularly those who happen to be financially asset rich. If you've got lots of financial assets, you own lots of equities, and maybe you've got a couple of properties in London or something, you've done really well out of QE because, of course, that has been a portfolio channel that's worked very nicely. It has encouraged people to get out of fixed income instruments into these riskier areas, which is precisely what the Bank of England want to achieve in the first place. But here's the catch. People who typically rely on wage income and don't have financial assets tend to have a relatively high marginal propensity to consume. They spend quite a lot out of their income. People who happen to have lots of financial assets are pretty wealthy in the first place. They might see their assets rise in value thanks to QE, but they're partly indifferent about it. And the consequence is their marginal propensity to consume is relatively low. So if effectively QE helps to redistribute income and wealth away from those who are on wage income towards those who are financially asset rich, in aggregate, on average, you end up with a reduction in the marginal propensity to consume, which in turn suggests that actually the impact on demand is smaller than the Bank of England originally calculated. And I would like to argue, in fact, that monetary policy in this particular way is becoming more an instrument for the redistribution of income and wealth, rather than being a key driver of economic recovery. And I raise this question as to whether it should be central banks who should be responsible for these decisions with regard to the redistribution of income and wealth. Or put another way, I think the central banks are asked to do a bigger and bigger political job because the politicians themselves don't want to do it. And therefore, you end up with these peculiarities of central banks getting themselves into a bit of a mess as a consequence of these redistribution effects. Now, you might say, well, this is all very well, but although things haven't worked very well in the UK, they have worked much better elsewhere, and the US is the prime example of this. Well, this is one way of demonstrating the story. This looks at the US economy compared with other economies since 2008. So I've indexed the level of GDP to equal 100 in 2008, simply tracked how economies have performed since then. And what you can see from the red line, which is the US, it's had by far the best performance of any of the G5 countries. And you'll notice also that the UK is lagging behind as the worst performer. So one country has apparently had a successful application of QE, and the other has done relatively poorly. And perhaps the big fall in sterling was part of the difference between the US and the UK. But before we get too excited about the US, I know people are excited about the US, saying it's begun to change dramatically. Here's another chart which looks at the same sort of story. Bear in mind that red line in this chart. The red line in this chart is the equivalent of the black dotted line in this chart. And this chart looks at the US economy in this economic cycle compared with the equivalent period in previous US economic cycles. So rather than a geographical comparison across countries, this is a historical comparison across different US economic cycles. And what this demonstrates is that even with QE, the US, by its own very high standards, is doing lamentably poorly at the moment compared to what's happened in the past. So even in the US, which is more dynamic, the growth rates that we're seeing are much, much lower than was the case previously. I think this is a Western condition of structurally lower growth rates, which raises a whole bunch of questions about how we cope, not just economically, but also politically and socially. One final point on this, which is that although the economy has done relatively poorly, the US stock market, again it's the black dotted line in this chart, hasn't done brilliantly, but in real terms, taking into account dividends, actually it's done something which is not so different from the experience in the past. So what we've seen effectively is a breakdown in the relationship between financial assets, which have risen very strongly thanks to QE, and the performance of the economies, which have actually been rather poor. And I raise a question here as to how long financial assets can, if you like, defy gravity in the years ahead, if indeed economic performance remains relatively weak. Or do we just become increasingly dependent on QE drugs year after year after year to make sure that we can defy gravity for just a little bit longer? Now, at this point, I want to refer to the first fat cat, because I want to get into issues that are associated with the stagnation of Western economies. This has happened before, and in the book I refer to a number of different examples, going back to the Peasants' Revolt in 1381, through to the French Revolution a little later on. And actually, this is one of the key players in the French Revolution. It is Louis XVI. Now, what you'll notice about this portrait is that this was the most flattering portrait the artist could produce. I can assure you that Louis XVI was quite a lot plumper than this. He looks pretty plump anyway, but actually he was very, very plump indeed. I know this for a fact because during the Revolution, when he was guillotined, there's a rather sort of unpleasant story about this, actually, apart from that he was guillotined, which itself was unpleasant, which is that he was so enormously fat that the blade couldn't get all the way through. Had to be finished off with an axe. I'm sorry to mention this, it rather ruined your lunch, I suspect. But the key point about this is that, of course, the French Revolution was partly a consequence of economic failure, where the distribution of that failure was seen by many in society as grossly unfair. So going back to the history of the French Revolution, you had, in the 20 or 30 years before the French Revolution, a period of continuously rising living standards. And actually, if you look back to what de Tocqueville wrote about the French Revolution in the 19th century, he pointed out that over that previous 20 or 30 years, living standards had risen pretty rapidly. It was true that government debt was pretty high because of the wars of independence in the US. But nevertheless, living standards had risen. There was the emergence of a new sort of middle class, a new industrial area. Things were beginning to transform. But at the same time, there was no significant change in the way in which the French economy was being run. It was still the clergy and the nobility who were in charge, and neither of them had any interest whatsoever in paying higher taxes. So when there were attempts at tax reform, it never actually happened. And then, unfortunately, there were a series of bad harvests, a hailstorm and other bits and pieces that led to the destruction of the wheat crop, and the consequence of that was a surge in wheat prices, which then led to a massive increase in bread prices. And suddenly the third estate, the people, the workers, the peasants and so on, were in really, really big trouble, despite the fact that Louis and his mates continue to live a very pleasant life. And my point about this is that when you have a situation whereby you end up with unexpected economic stagnation, problems of high levels of income inequality become much bigger than is the case during expanding economies. During periods of expansion, we can cope with high levels of income inequality, but when it comes to stagnation, it is much more difficult, and that's the point when you start to get political and social upheaval. In fact, one of the lessons from the French Revolution I could possibly apply to the Eurozone crisis today, because you could arguably say that the equivalent of the clergy and the nobility not wishing to take any losses whatsoever are those creditors in Northern Europe, like the Germans, who say, well, it's all someone else's fault. And those who are the equivalent of the third estate are the workers in Southern Europe, not necessarily the governments or others who, in some cases, were fictitious about their fiscal numbers, but the workers in Southern Europe who are suddenly faced with the possibility of austerity year after year after year. And I think that's a powder keg which is not exactly stable and does raise some big issues about how the Eurozone progresses in the future. But anyway, I want to, at this point, move away from the fat cat and to another person who was writing at roughly the same time, and that was Adam Smith. I thought I'd better mention Adam Smith in Edinburgh. But importantly, there's a bit that he wrote about in terms of different kinds of states. And the great beauty about Adam Smith is there's no sort of nonsense about econometrics or anything like that. It was all just stated in sort of normal English language. And he talked about three states of nature and making a moral case for economic growth. He talked about the progressive state, which effectively was the state in which you had continuous economic expansion, where everyone could be happy at the same time. And the West has been living through that over the last 50 or 60 years broadly, on and off. Then you have the dull state, which effectively is what you might call stagnation, and the melancholy state, which is where economies are, in a sense, contracting. And the point about stagnation and contraction in these dull and melancholy states is that if someone becomes better off in that state, it basically implies that someone else becomes worse off. It may not be their fault that someone else has become worse off, but nevertheless, there's a connection between the two. And in a dull state, the danger is that people begin to worry about losses rather than gains. They begin to believe there are no gains to be had. So they become loss averse. And we know from behavioral economics that people can be loss averse. In fact, it's the actual normal circumstance of people to be loss averse. So in a loss averse world, people just stop taking risks. They become a lot less entrepreneurial. And if everyone is loss averse, everyone's worried about losing money they've already got, then of course society begins to stagnate. And what you also begin to see is a breakdown of trust, because in this stagnant world, people begin to think, well, someone else has made money only by effectively taking advantage of me. And the breakdown of trust begins to eat away at the underlying fabric of how markets themselves actually work. Actually in the book I quote Kenneth Arrow, who talks about this issue of trust. He said basically it's a social public good. Countries that have high levels of trust tend to do pretty well because they can have these market connections and people trust each other. With low levels of trust, you get the risk of continuous stagnation. And I would argue that in society, in Western societies, and partly because of the banks, I have to say, there's been a breakdown of trust, which I think has eroded the ability to have those, if you like, market-driven commercial decisions, which actually has eroded growth over the course of the last few years. So this raises two key themes in the book. The first of which, nice cheerful title of this particular chapter, is dystopia. This raises issues about what may happen in the years ahead if we can't deal with these issues of trust, we can't deal with these issues of loss aversion, if we're faced with continuously large amounts of debt and not sure exactly who picks up the bill for these high levels of debt. Well, you have globalization in reverse, one significant risk. Continuous mistrust of banks. If you look at recent Gallup surveys for banks in America, the level of trust is remarkably low, and I'm sure the same is also true of the UK. And with mistrust of financial institutions, that also creates a problem in terms of longer-term growth. Mistrust of government. One of the potential weaknesses of the Keynesian solution is that back in the 30s, and even in the 1970s, governments, for the most part, were trusted. Oh, that was a bit painful, wasn't it? Was that me? Maybe I have indigestion or something coming through. But governments were trusted back then, so when there was a big fiscal stimulus, the assumption was it would actually work. But look at levels of trust in government today. Incredibly low. There was a Gallup poll recently asking Americans, what percentage of your taxed dollar is spent wisely? And the answer was less than 50%. That's not particularly encouraging. So although it's true that in a Keynesian world, government stimulus might work, in a less trusting world, it may not work anywhere near as well. Mistrust of money. The more in which central banks are under pressure politically to do stuff to encourage growth, the bigger the risk is that we lose trust of money altogether. And I don't want to be completely negative here, but there are certain countries like Japan, for example, which are becoming so experimental with monetary policies that it's not impossible to rule out the possibility of some kind of move from deflation all the way to the opposite extreme of hyperinflation. Then you have what I call the stately home effect. If we want to live beyond our means in the short term in the West, we can do so by flogging off all our assets to those with deep pockets like China, India and elsewhere. And we're beginning to do this. Look at increasingly large number of European companies being sold to investors elsewhere in the world. That helps us to consume in the short term, but of course it means increasingly the dividends will go to those investors rather than to us over the medium term. And the reason why I call it the stately home effect is this, of course, is what many stately homes in Britain did during the 19th century, basically selling off the family silver and beginning to realise that they simply couldn't run the stately homes the way they had done previously. The possibility of the Eurozone crisis getting worse. And this comes back to this issue of the relations between the creditors in Northern Europe and the debtors in Southern Europe. We know from history that ultimately creditors end up paying a big proportion of the bill. But the more they resist doing that, the worse the crisis tends to become. So although we've had all sorts of help from the ECB, I would argue that currently in the Eurozone, there's still a great deal of instability to come. And that instability will also, I think, be reflected in a possible increase in political extremism, the rise of economic nationalism, political nationalism, not just in the Eurozone, but also in the UK, I think are worrying trends in many ways because they are a reflection, in my view, of these increasing concerns about societies not functioning well, economies not growing particularly quickly, and everyone looking for someone else to blame for it, which is dangerous and points to some reversion of globalization. Anyway, the good news is they have some answers for all these things, just in case you become really depressed. But there are some answers. The only problem with the answers is that you might think that they're all quite tricky. So here are some suggestions. The first one, what I call dealing with space, dealing with the relationship between international creditors and debtors. Now, go back to the Eurozone crisis. Whose fault was it? Was it the fault of those in Southern Europe who borrowed too much? Was it the fault of those in Northern Europe who lent too much? And I'd argue that actually part of the fault must lie with those who lent too much. I think there's a rather Victorian view about debt these days, which is those who've got too much debt are at fault, and those who lent to them are perfectly innocent, did nothing absolutely wrong at all. But actually, those who lent had choices. So the Germans, for example, who ran this very, very large current account surplus in the years up to the financial crisis, could have chosen to use their very high export revenues to invest in German domestic industry, in which case there would not have been such a big current account surplus because investment domestically would be higher relative to German savings. Or instead, German companies could have paid away the higher export revenues in the form of higher domestic wages, in which case domestic German consumption will be higher, again the current account surplus will be smaller. But Germans didn't do that. They said, no, we want to save this money. We'll save it for a rainy day. And we want to invest somewhere in the world which has no currency risk, but really quite exciting yields compared with German bunds. So what do? They said, I know, Greek government debt, that's really exciting. That's offering a few basis points higher than German government. Let's go there. Spain, Portugal. So you had more and more money flowing into those parts of Southern Europe. And I would suggest it was partly a consequence of the Germans not recognizing that they themselves were taking risks with their money. The Germans will eventually have to pay. And so what I would suggest is, in terms of a longer term reform, is that those countries running large current account surpluses should be in one sense penalised as much as those who are running large current account deficits. There should be downgrades from ratings agencies, not just for those with large amounts of debt, but those who are lending too much in the first place. Both of them are equally at fault. You can't have the whole world in current account surplus unless you're doing trade with Jupiter or Mars, which I think is not quite possible at this stage. Dealing with debt, the Eurozone crisis, well, here I think you ultimately need to decide what you want from the Eurozone. This is an interesting debate in the UK, of course, but I would suggest that for any monetary union to work successfully, it has to have some kind of political and fiscal union too. The history is very clear on this, that countries without that tend ultimately to see their monetary unions falling apart. Now, of course, there's a big question as to how you get there. And even if you had that political and fiscal union, does it actually solve the whole problem? The answer is no, it doesn't. Because there's an additional issue in Europe now, which is the very high levels of debt in Southern Europe and the continuous austerity under which they'll be pressurized. So I think you need to have the creation of a political and fiscal union, and also you probably need to have one-off debt restructuring in Southern Europe, which is going to be very difficult. But again, maybe that's the answer. dealing with debt for countries with floating exchange rates, what you need here is a kind of new, revitalized Graham-Rudman deal. Now, back in the 1980s, the Graham-Rudman deal was designed to guarantee the US would automatically reduce its budget deficit unless there was a recession. So you have a get-out clause during periods of economic weakness, but you make a longer-term commitment to saying, yes, we can't have a continuous increase in the size of the state as a share of GDP. It has simply got too big. That's something which also I think will have to change. Dealing with time, enfranchising the future. What I mean by this is that we have a society which is dominated democratically by the baby boomers. I'm at the very tail end of the boomer generation, but the boomers in one sense have it pretty easy. They've had a very good life over the last 50 or 60 years, rapidly rising living standards, and they're also making very big claims on the future in terms of healthcare, pensions, and so on and so forth. What I'd like to argue is that we should be thinking more about the younger generation, a new kind of social contract which looks after the interests of the younger generation, and having done that, you then say, well, how much money is left over to look after the rest of us? And that comes back to a question about retirement age, the amount of medical care that's available, how much we should be spending ourselves on medical care, a whole bunch of issues of that kind. It's interesting looking back at the Beveridge report, which was the beginnings of the welfare state. It was only supposed to provide a bare minimum rather than everything. We've actually moved a long way away from those principles over the course of the last 50 or 60 years. Dealing with the banks. Yeah. Now, you might think I'm a biased observer in this particular one, but I have been quite critical about banks in the book. I do think that, well, there are a number of problems. The first one is that we have to accept that capitalism works on the basis of beliefs that may simply be wrong. And one of the reasons why we have financial bubbles is that lots of people believe that something's going to happen, which then doesn't happen. Is that the fault of any one individual, someone who's effectively milking the system? Not necessarily. It's a feature of capitalism that's been there for 200 years or so. So we have to accept that capitalism comes with costs as partly to do with the instability of those beliefs, those herd instincts, or those sort of delusions that we all suffer from time to time, like, for example, the dot-com bubble at the end of the 1990s. At the same time, I think that during the financial crisis, there really have been some significant difficulties in trying to work out how to deal with those who may have misbehaved in some way or another. And what I would strongly urge is that bankers, particularly senior bankers, should be effectively forced to stick to some kind of equivalent of a medical code of ethics, certain kinds of behavior which make very clear what the punishments are if they misbehave. I mean, if you're a doctor who misbehaves, if you misbehave pretty badly, you're struck off. If you misbehave very badly, you go to jail. And none of those things have been in place really from the point of view of bankers, and I think that maybe that's what's actually required. This is important from the point of view of restoring trust within the banking system. If there's a sense that people can walk away with lots of money and no punishment when they've done something wrong, that strikes me as being morally, ethically wrong, and that should be something that actually really ought to change. And so you've heard it from me. And then finally, and this is important for where I am today at the University of Edinburgh, is education for economists. Now, there was a very interesting debate that took place in the Bank of England around about a year ago, which led to a book actually edited by Diane Coyle, who's one of the great economic thinkers in Britain, about the teaching of economics in university. The question was, are we teaching the right kind of economics? Now, I'm an employer of economists, and what I'm really amazed about economists coming out of university is that they're truly brilliant in their quantitative techniques, their mathematical skills, their econometric skills, their ability to deal with spreadsheets, their ability to build intricate mathematical models that work in fundamentally brilliant ways. What they're not so good at, perhaps, is knowing a great deal about economic history, about some of the really big issues that have happened over the course of the last 100, 200 years, about the kinds of really big issues that really matter from the point of view of policymakers, because the models often are estimated only over a 10, 20-year period, and effectively, therefore, by definition, exclude a lot of the interesting periods. And we pretend that somehow we've taken control of our economies in a way that simply isn't true and never has been true. And we sort of make ourselves think that somehow everything is absolutely okay, when actually it isn't. So I would urge that economists at university and beyond should do a lot more in the way of economic history. In fact, I would prefer to make economic history compulsory as part of university degrees, because without it, I feel that economists can't talk sufficiently well about austerity that happened in the UK in the 1920s. It's a very good example of austerity. Or to talk about what you do in the case of a depression, People might know about the 1930s a bit, but often they don't. Or to go back to these political, social upheavals which are associated with economic failure. All these things are really, really important. And I think that the economics profession needs to get a much better grip of those kinds of things if it's going to still remain relevant for policy making in the years ahead. So on that note, thank you very much indeed. Thank you. Too long.
Wow. Well, you heard it here probably first, and that last comment I think is extremely interesting for any members of faculty in here, and of course students who sit with them. Jean, thank you. He seems we'd take some questions. We said we'd be sort of done in here by past, but you can go on asking questions outside. There's coffee at the garden. Perhaps in the last few minutes in this room, people would like to ask questions. Could you please, when you ask a question, say who you are? And could you please ask a question rather than make a statement? That would be helpful. Who's going to go first? Gentleman here.
Chris Gower, a professor of corporate strategy. Just a bottom line question, really. My global emerging market bonds have gone up 18% in the last year, compared with 28% for the UK and 30% for the USA. Now, were the gems just too high in the first place and silly, or are we going to see a reversion of that trend in 10 years' time, with the UK-US coming back down and the gems being the long-term growth coming back up eventually?
First of all, I'd say that the American and British numbers are partly influenced by QE and partly influenced by the Eurozone crisis, to the extent that people wanted to get into some safe assets, and that included stuff that was outside of Europe, or at least was in Northern Europe, which helped both the US and the UK. And in that relatively risk-averse environment, people were not so interested in emerging markets. I'd also note, actually, that although it's true that emerging markets have underperformed, it is still the case that the emerging market spreads over treasuries and so on are actually quite low currently. I think there are a number of stages of this story. The first stage is this: with more and more QE coming through, I think people will go back into emerging market debt. Yields will come down further, so the returns will go up. That isn't because people think that emerging markets have improved. It's because there's basically a global hunt for yield going on. And that hunt for yield is really a return to the conditions you saw in 2005, 2006, 2007, which, in my view, should be worrying. I mean, in other words, central bankers have created precisely the conditions that we saw before the last financial crisis, and it might suggest there's a further misallocation of capital going on. I spoke to an emerging market expert just recently who said that in his markets, it felt like a return to how it had been in the mid-years of the last decade, and that for him was worrying. So I think you may get some further returns over the next few months. Then I think there's a risk next year, the year after, that spreads will widen out again because there'll be some kind of risk-off accident, whether it's maybe some tightening of policy eventually in the US, or whether it's, I don't know, an oil shock, or whatever you can think of. There's a whole bunch of things that might happen, possibly even just the slowing of China, which then makes it more difficult for parts of the emerging world. But longer term, 5, 10 years, I can't help but think that emerging market themes are the ones that will dominate. So it's as always with emerging markets, it's a bumpy ride, but I think that for the time being, it's basically a monetary-driven story rather than a fundamental-driven story.
Lady here.
Hi, Master Bradley. I'm from University of Glasgow. I really liked your analysis, very good. I think you address fundamental issues in your solutions. Just have two things.
There's a butt coming, isn't there? I can tell that. Yeah, I can tell. Yeah.
There are two things I think that perhaps you don't cover, maybe you deliberately don't cover, but there are two things. One is that in your initial parts of the slides where you mentioned that the key exporters outside the commodity producers to China, one US and one Germany.
Yeah.
And there are two leading technologies in different areas. So you have US cutting edge technologies and Germany, which is a sort of the manufacturing world, machine-based leader in technologies. That basically gives you a hint why they exported. They're not commodities, but they were catering to the structural changes going on in China. The structural changes that will take place in Africa in the coming decade, or which you implied India and China will cater to with their cheaper cars or their cheaper not necessarily insecure, but lower levels of, again, engineers or exporting techniques towards the structural requirements of those countries. Mm-hmm. Now, can you say the solution for the Western world is just to do this, or they are actually to change their basic exporting focus to the structural requirements of the changes going on in these other countries, combined with one other aspect, which you say where I think where the link comes. QE was a tool, as you say, to create money supply, only it didn't get into the real economy, it got into assets. Now, this was compensated in the US and
Questions
Germany.
come, questions coming.
Sorry, this was compensated in the US and Germany through the US admin banks or through the KfW through long-term financial supply to SMEs, which are again your niche suppliers to long-term. So where do you fit that in your, it's the long-term financial supply to your SMEs, which would generate exports, which would probably create a solution to the Western.
Well, it's certainly true that the UK has been very poor at giving money to SMEs, and there are a variety of reasons for that, but I think that QE itself, almost by design, was misdirected towards other parts of the economy rather than SMEs. So I think that partly through the funding for lending scheme and partly through, I think, perhaps further changes that Mark Carney might bring along, we might get more help for SMEs in the future. And I absolutely agree that it's SMEs that really need to be helped in terms of future growth, because big companies already are big, so what? But it's the small companies that really matter. The other thing I mentioned is that I think for Britain compared with Germany, one thing that continuously crops up is the issue of how we invest in relationships with other parts of the world. The German Chambers of Commerce are one particular example of how it's not just long-term funding, but long-term connections that are built up steadily year after year after year. There are many of those in China operating already, which provide a help for German industry across the board. Our equivalent to the German Chambers of Commerce is to have a member of the royal family visit the particular country, shake a few hands, and then say goodbye, and then we hope that that's going to be a springboard for export success. And I've got nothing against the royal family, but I think that on its own probably isn't a sufficient investment. So I think there are other issues out there in terms of how we connect with the rest of the world.
Vince Cable wouldn't like to hear you saying that, but I know exactly what you mean.
I bet you secretly agree. But
Question over there. Yep, there's a gentleman at the back.
Yeah, hi. So we have this
Can you say who you are?
Sorry, David Fenton from the Royal Bank of Scotland. The distinction between international creditors and debtors and surplus nations and deficit nations. But China's got its own problems with debt as well, despite being a surplus problem. How much weight or significance do you attach to a lot of the reports we've seen recently that the property market is increasingly out of control, and that even if it doesn't change the structural dynamics that are going on here, so there's a big cyclical problem coming their way?
Quite a lot of weight to that. I mean, in part because it's clear that Beijing itself is really worried about these kinds of issues, particularly the social lending growth, the extent to which we've seen disintermediation into the growth of wealth management products that are another way of raising funds rather than through the banking system. There's a whole bunch of these issues that are cropped up. I would argue that what China's trying to do to deal with that and to deal with potential future risks is to try to support the economy through what you might describe as traditional Keynesian pump priming, infrastructure investment of one sort or another, which is effectively trying to deal with the gap between an export-led strategy of the past and what will have to be a consumer-led strategy at some point in the future. And that's what they're trying to do. The problem, however, I think, is that the combination of rapid credit growth and infrastructure investment is, by the looks of things, leading to a significant drop in the marginal return on capital, which raises questions as to the sustainability of the current model. Now, one defense of this is that, well, actually, infrastructure projects pay off over a very long period of time. And therefore, we won't know for another 5 or 6 years whether this money was spent wisely. But the other view, of course, is to say, well, infrastructure projects often are wasted money. So we may discover that actually the returns on those infrastructure projects are lower in 5-10 years' time than are currently being assumed. But in terms of accidents, I would argue that if people make comparisons with Japan, say, well, isn't it like Japan in the late 1980s? One big difference is that per capita incomes in China are only about $6,000 to $7,000 a year, compared with $30,000 a year in Japan at the time of its crisis. Lots of cashing out still to do. But also, I'd argue that Japan's story, perhaps the more relevant one, is Japan in the mid-1960s, rather than the late 1980s, where again there had been a bubble associated with the Tokyo Olympics. There was a collapse in the economy of sorts, but it wasn't very long. Didn't damage anyone, and there was a very quick recovery thereafter. largely because I think Japan back then was driven by supply-side factors rather than demand-side factors. And the whole process of urbanization, the opening up of the Southern Silk Road and so on, I think are factors that will help China in the future. But yeah, I mean, next year or two, it's going to be a bit of a tightrope and a little more risky than perhaps one would ideally want to see.
One more question we wrap up there, yeah? Yes, the lady?
Hi, I'm Amy and I'm from the business school here. In the Western, particularly in the Western countries, we've had this long-held ideal of central bank independence, or like a separation of monetary and fiscal policies. But yeah. With the rise of Asia, many countries whose central banks are not independent. What do you think about the future of this ideal? I mean, do you think it's a sustainable kind of...
I think independence of central banks is granted and then taken away. They're never really independent. They're only independent when it suits politicians for them to be independent. And actually, the more you get into this distributional issue associated with monetary policy, the less independent they will become. And actually, in the book I talk about the debates about gold in the US in the late 19th century, because the US went onto a gold standard back then, which effectively was a kind of 19th century version of inflation targeting. And it led to a kind of Eurozone-style crisis, because although gold seemed to be like a perfectly reasonable thing at the time, there's no doubt that by being on gold, it created huge deflationary tendencies within the US, which was fine for the northeastern states who are creditors, but very bad news for those in the southern and western states who are mostly debtors, particularly farmers. And the consequence of that was a huge political battle. So I think that we have to accept that monetary policy has distributional effects, which I think central banks have pretended don't exist. And when you have a stagnant economy, you've got those distributional effects. I think that central banking policy is no longer really for technocrats, but it effectively becomes increasingly political, and therefore political oversight will almost certainly increase. So.
Right, thank you. Well, I think now the time has come to draw matters to a conclusion. Obviously, I cannot thank Steve enough for really so kindly being here to talk to us. And for the lady from Glasgow, just so that you know, he moves from here this afternoon in the train to Glasgow. He's speaking there. You're going to come again? Are you going to come again? He'll be speaking there, and then he will be speaking tomorrow morning to HSBC and other people in their head offices there in Glasgow. So thank you for coming. I don't want to get between him and his book sales, or we do between you and the biscuits and the coffee and the tea. But what I would like to say is this. You've seen here an example of what we can do when we get a speaker of this calibre to come to Edinburgh. When we launched the Institute last year, someone in the front row launch said, "Why do you think you'll ever get really good people to come up to Edinburgh to talk?" An outrageous comment. And I hope that those of you that are here would agree that being able to get people like Stephen and then Jim Leal coming up later on, and in September Lord Desai, is exactly what we should be doing here. Please don't lose the sub point in here, which is to engage with these markets. You need to understand how to do it, and that is the program that we are running out now. And we can only achieve that if particularly some of the younger people in this room sign up for our programs so you know what's happening, get onto our mailing list, come to our events and bring people. We will be looking at things like contemporary Chinese art as an asset class. We will be looking at other issues as they relate to security. And for example, later this month on May the 28th, at the New Club, we start the first of our Brookings Institute Scholar Briefings, when Van der Velberg-Brown is going to talk about aspiration and ambivalence, which are the strategies and realities of counterinsurgency and state building in Afghanistan. I don't have to tell people in Scotland the cost of blood and the price of soldiers going out there and other civilians being killed. Is it worth it? What happens afterwards? This is an economic issue, and it's a market which may have huge potential in the future. And then, as I mentioned, that's taking place at the New Club on the 28th of May. There will be other speakers coming here. So this institute's being created for you people in Scotland by us. We want it to work. We've got a very rich program going forward. And thank you for coming. And thank you again, Stephen. And buy the book. Tea, coffee, more questions if you want out there.
Do you want? Sorry.